Coming up on Business Incorporated. Africa Development Bank's 2022 Annual General Meeting ends today. And the European Union is working on a deal to import Israeli gas through Egypt. Plus, Zimbabwe is easing controls on the national currency's official exchange rate. Hello and welcome to the program. I'm Ladi Williams. We kick off with trading numbers from the African continent, where sentiment with markets we track are mostly positive. And today, Nigeria and South Africa were both in the green, with the NGX up 0.02%. It's a marginal increase there, while the South Africa index was up 1.20%. Well, Egypt lost 0.46% from its all-share index to close on Thursday. Elsewhere on the continent, Kenya gained almost 1% at the close of trading on Thursday. Meanwhile, in the Middle East was mixed sentiment for the markets we track. The United Arab Emirates, Dubai shed 0.01% off its index, and Abu Dhabi gained 1.73% at intraday. Meanwhile, Qatar and Saudi Arabia and Egypt were closed today, but they closed quite mixed yesterday. And over to Europe now. Alarmed by the prospect of global food shortages due to the conflict in Ukraine, the EU wants to get as much land in Europe as possible to turn over to grains, even at the cost of biodiversity. Well, we have Chris Koba right there in Berlin. Great to have you, Chris. So the German government is pushing back at these plans. Why?
It is mainly the agricultural ministry that's pushing back here, which has been led by a member of the Green Party since last fall's election. Now, the argument within the ministry is that the extra area that Germany could turn into crops under the new EU rules would not make an impact globally. Germany produced around 42 million tons of grains last year. Now, using the 170,000 hectares of fallow land would have increased annual production by 600,000 tons, which is less than 1% of Ukraine's annual grain production. Now, instead, the decision was to allow the land to be used only for livestock fodder, which is less detrimental to local flora and fauna, as it does not require fertilizer. That's the word from the ministry. Now, an EU spokesperson said Germany had notified the Commission that it will not make use of the exemption granted in March for this year. Now, 1 month into Russia's invasion of Ukraine, the European Commission decided to let farmers temporarily grow crops on land that is set aside to boost biodiversity, a step welcomed by farmers' lobbies. But environmentalists fear that agribusiness lobbyists could seize on the current crisis to push for the bloc to lower ecological standards coming into force next year under the new Common Agricultural Policy. And this announcement by the German Agricultural Ministry reflects greater influence of the Greens Party, who became part of the new three-way coalition government last year on German agricultural policy, with a new minister calling for more organic farming and criticizing cheap meat prices in a land, mind you, which is known for its €1 sausage.
Quite interesting, €1 sausage. But why could the problem of food insecurity become worse, in the coming weeks?
Because heaps of grain are sitting at Ukrainian ports, and the question of how and under which conditions they can be sent abroad has become a hot-button issue. Russia is so far preventing the shipping of millions of tons of agricultural products, but is now trying to shift the blame, demanding that Western sanctions needed to be lifted, and it was the West and its actions that were worsening this food crisis. That's what Russian leader Vladimir Putin told Italian Prime Minister Mario Draghi in a phone call. Mr. Putin spoke of a, quote, significant contribution that Russia could make in overcoming the crisis. Ukraine is one of the world's largest exporters of wheat, corn, and sunflower oil, but the war and Russia's blockade of its ports have halted much of that flow, endangering world food supplies. Many of those ports are also now heavily mined. Russia, for its part, is also a significant grain exporter and claims that Western sanctions were hampering the country's ability to charter ships and export grain. Now, the United States has rejected Russia's demand, a spokesperson for the White House saying it was Russia's naval blockade that had stopped tons of products from being shipped, not the sanctions. And this sentiment was echoed by allies in Europe, with Britain accusing Russia of, quote, trying to hold the world to ransom, insisting there would be no sanctions relief. So there seems so far little chance of getting out of this impasse, with fears growing that those already experiencing hunger in the world could face even more hardship.
Quite a bleak outlook there, but let's get a quick check of financial markets. How are the stocks faring today?
It had been a strong day for German stocks yesterday, which were still traded despite it being a public holiday here in Germany. The DAX gained about 1.5% on Thursday and is holding on to some of these gains today, advancing about 0.5% in early parts of trading. Overall, European stocks are also edging higher, taking their cue from gains in Asia and a strong session on Wall Street. The positive mood came after Federal Reserve minutes indicated the U.S. Central Bank could take a breather in hiking interest rates if inflation shows signs of easing later in the year.
Right. Well, we'll all be looking out for that. Thank you so much, Chris Kober, right there in Berlin. Well, let's head on to the UK now. We have Juliana standing by right there. Great to have you, Juliana. Still about rising cost of living in the UK. The windfall tax still trending, and Sunak says a cost of living package will have minimal impact on inflation. How are analysts and economists reading this?
Good afternoon, Laddie. Well, there's been mixed reaction to the Chancellor's £15 billion giveaway yesterday. Some Tory backbenchers wanted this, of course, because they can see their constituents are struggling, especially yesterday during the statement. Lots of people standing up, talking about children going to school hungry. But on the other hand, if you think of a traditional Conservative government, fiscal prudence is a way that you would describe them. And there has been lots of mixed messaging out of the Treasury over the past couple of weeks. So we know that there will now be a windfall tax on energy firms, 25% taxed on their profits up until December 2025. No surprises that BP and Shell's shares have fallen today. Investors really are not happy about that. But then people are asking, why has the Chancellor decided to do this when last week there were 3 votes in Parliament and Conservative MPs were told to vote against that? What message is this sending? Some papers have dubbed the Chancellor checkbook Chancellor. They think this giveaway is just way too much. If you are a traditional Conservative, you're not happy with the fact that you're struggling at the moment, but because you have more in the bank, you're not getting any of the help, apart from, of course, that £400 that every single person in the country will get if you are connected to electricity. But businesses say they need so much more. Also, as well, if you are from, I would say, the least privileged part of society, you are going to receive about £1,650. I tried to calculate that. I believe that's about £1 million naira. And some people are, again, suggesting the country just cannot afford this. And the knock-on effect of pumping money into the economy is, of course, inflation. Now, the Chancellor has been doing the rounds on British media this morning, saying that he doesn't think the £15 million package is going to affect inflation too much. But then, of course, how can it not? Because people are holding back at the moment. They're not buying. You give them an injection of money, they are going to buy, which means, of course, there is going to be more demand, less supply, inflation starts to surge. So I'm surprised I'm saying this, but I do feel a little bit sorry for the Chancellor because people asked, he delivered, and now people are not happy. On the one hand, people don't think it's enough. On the other hand, people think it's given too much. Lose-lose situation.
Lose-lose. Quite interesting. Today. Yeah, quite interesting that we're also talking about a stimulus package, at this time. But the British pound looks set for a second weekly rise and was close to a 1-month high earlier. How's it looking?
Yeah, no surprises. The British pound is rallying against the US dollar. Of course, once people are given an injection of money, £15 million, it means they're going to spend. So, of course, the pound would be surging on that. The FTSE All-Share is up by 0.23%. The FTSE 100 up by 0.13%. And the FTSE 250, the domestic market, up too by 0.35%. Now, in the currencies market, at the moment, the British pound will buy you $1.26. It will buy you €1.17 and 160 Japanese yen at intraday, Laddie.
Quite interesting. What are we expecting for next week, talking about economic data?
Well, it's a good question. Next week, I've got to tell you, we are going to be having a very, very busy week. I don't know if you've heard, but Her Majesty the Queen is celebrating 70 years on the throne. And I can tell you now, Britain is basically going to be shut down, especially here in central London, where our studio is based. This has been years and years and years in the planning, and there's nothing the establishment likes to do better than put on some pomp and ceremony, and that is what you can expect throughout next week from the UK. We are going to be very, very busy, so most of the time people see me, I will be out and about trying to speak to some individuals. Why does this matter economically? Well, the British monarchy contributes roughly £2 billion each year to the British economy. When people come to London, the vast majority of people do go to Buckingham Palace. In fact, Meghan Markle, when she first came to London, when she was about 10 or 11 years old, was famously pictured outside Buckingham Palace. Thursday and Friday are bank holidays. There are 2 bank holidays in Britain. Next week, there's going to be lots of preparation. Expect many heads of states from across the world to be flying in to celebrate with the Queen, including a large delegation from Nigeria. So I will keep you tuned. We will have some business news for you, don't worry. But I think it's all about the Queen next week, Laddie. Thanks for
all
asking,
about the Queen
by the
next
way.
week. All right, we'll be looking forward to that. Thank you so much, Julianne. Enjoy the weekend.
Thank you.
All right, now, so today is the last day for the Africa Development Bank's 57th annual meeting. The theme, Achieving Climate Resilience and a Just Energy Transition for Africa. Well, our correspondent, Teniola Shobowale, was there from day one, right there in Accra, Ghana. Great to have you, Teniola.
It's been a long week.
I can imagine, yeah, a week-long meeting, and it's the final day today. How's it looking today?
Well, today we're going to have the closing ceremony, and then we'll have a closing press conference in a few hours. But earlier we were in a session talking about green growth and green jobs for youth and women. As you mentioned, the theme for this annual meetings is focused on a just energy transition for Africa. So the focus really this week has been on ensuring that Africa gets the funding it needs for climate adaptation. And it's really important considering that the COP27 is coming up later this year in Egypt. So the focus mainly has been on ensuring that Africa gets the funding it needs, the funding that's been promised by Western countries. As we all know, Africa is the least contributor to climate change, but we're already seeing the devastating impacts of it, like what we saw in South Africa recently. And there's also been a lot of focus on, of course, the war in Ukraine. You can't get away from it, really. And it's really just about ensuring that Africans don't go hungry as a result of the war in Ukraine. So there's been a lot of focus on that and ensuring that Africa is able to produce its food. The African Emergency Food Production Plan, we'll speak a bit more about that later. Another highlight of from the week is the economic outlook of the African Development Bank, which says Africa's gross domestic product has recovered strongly in the last year. But then the lingering effects of the COVID-19 pandemic and the Russian war of Ukraine, is just hiding behind the corner. And that's also threatening the growth of the continent as well. Speaking about Nigeria, the AFDB projects the average growth rate of the country's economy this year to 2023 at 3.2%. The report also estimates the inflation rate to remain elevated at 16.9% this year. So those are some of the highlights from the week. There's been a lot, and also talks on SDRs and so many more.
Right. Well, thank you so much, Teniola. We know we'll get more reports from you later on. That's Teniola Shobowale, a Channel TV correspondent right there in Accra, Ghana. Thank you so much, Tenny. All right, so we'll take a break now. When we come back, more stories on the African continent. Do stay with us. Welcome back. Still watching Business Incorporated. Let's get some U.S. Markets right now. Stock futures are slightly higher today as the S&P 500 attempted to snap 7-week losing streak. Futures on Dow Jones Industrial Average climbed 34 points. The S&P 500 futures and the Nasdaq 100 gained about 0.2 and 0.45%. Well, we have Maria Bird, a correspondent right there in the U.S. with yesterday's trading. We have Mary Bird with yesterday's trading.
The U.S. stock market ended higher on Thursday as the S&P 500 was up by 1.99%, the Dow Jones up by 1.61%, and the heavy tech Nasdaq was up by 2.68%. Many investors are hopeful for the stability of the U.S. economy as retailers showed strong on Thursday, helping the economy to have a boost. Retailers like Dollar General and Macy's were leading the way. The NASDAQ heavy tech industry, companies like Apple, Microsoft, and Amazon.com helped to end the NASDAQ much stronger. Many investors are hopeful this is a trend moving forward and will continue to watch to the end of the week and to next week.
Oh, that's correspondent Mary Bird with yesterday's trading. Well, to our next discussion now, the interest rate outlook in the Sub-Saharan Africa with global inflation on the rise, stoked by rising energy prices and the war in Ukraine. Central bankers all around the world are raising rates to curtail rising prices. And the African central bankers from Ghana, South Africa, Nigeria have raised rates recently. Well, to get an outlook, we have Matt Kindigan now, practice lead, Sub-Saharan Africa, front of you, join us right here. Great to have you on the program.
Hi, thanks for having me on the show today.
Right, so which countries are likely to, see more interest rate hikes, most rapidly in Africa?
Yeah, so as you mentioned in your introduction, we've already seen interest rate hikes recently by South Africa, very notably by Ghana, a 250 basis point hike recently. So we do expect to see South Africa and Ghana continue to pursue interest rate hikes, and this is for a number of reasons. In South Africa's case, interest rates are still very low by historical standards. They remain below pre-pandemic levels, and the central bank has made it very clear that it is willing to continue to tighten monetary policy to help curtail inflation, but also stabilize the value of the rand. In our view, South Africa's economic growth prospects are more upbeat now than they were 6 months ago. And this is because of very high global commodity prices, which are driving exports. So this does give the central bank, the South African Reserve Bank, slightly more scope to raise interest rates more aggressively than in other sub-Saharan African markets. Inflation is also expected to exceed the upper target limit of 6% this year. It'll likely peak above 10% year on year in in Q4 this year. And this is another reason for very aggressive interest rate hikes we're expecting. In Ghana's case, really, it's down to the fiscal pressures and the very significant downward pressure we're seeing on the currency, the cedi at the moment. So we do expect the central bank in Ghana to continue to pursue quite substantial interest rate hikes over the next couple of months. A few other markets are unlikely to see such rapid increases in interest rates. For example, the Kenyan central bank is most likely going to tolerate higher inflation for longer to ensure that the economy continues to grow strongly. And the Angolan central bank is likely to keep interest rates relatively low or where they are for the foreseeable future. And this is because inflation is actually falling in Angola, one of the few countries where that is happening. And also the Kwanza has been the best performing currency against the dollar this year. So it is very strong at the moment. So a slightly different approach for those markets.
Quite interesting. And, we've seen the Fed, raise rates and the dollar index actually get stronger. But what does this mean for, the currency outlook across sub-Saharan Africa?
Yeah, so this is the hot question at the moment. For the markets where we're going to see high interest rates, especially in South Africa's case, there's no doubt that the higher interest rate in South Africa, or higher interest rates that are likely to come over the rest of the year, will support the value of the rand and could actually result in quite significant volatility, because we have seen the rand lose value in response to increasing investor anxiety around the global economic outlook. It's worth remembering that the rand is often considered a bit of a bellwether for sentiment towards, or investor sentiment towards emerging markets. So higher interest rates will prevent the rand from depreciating to a certain extent against the dollar. In Ghana's case, however, we don't think it will be as effective, and this is partly because despite the very significant interest rate hikes in March, we've already seen the CD lose some value. For markets where interest rates are going to remain a bit lower, we do expect to see continued downward pressure on currencies, for example, in markets like Ethiopia and Kenya.
Quite interesting. But will higher interest rates affect, economic growth prospects in the region?
Yes, so currencies are only one issue affected by interest rates. We do expect to see some impact from high interest rates, some negative impact on from higher interest rates on economic growth in Sub-Saharan Africa. And this is because since the start of the pandemic, we've actually seen very strong credit growth across Sub-Saharan Africa. Kenya, South Africa, Ghana, even Nigeria has seen very healthy credit growth from commercial banks to the private sector. And this has supported very substantial expansions in activity in several industries, especially manufacturing, ICT, and in some cases, consumer goods, especially premium consumer goods. Now, with interest rates rising and inflation rising as well, commercial banks will increase their interest rates, and this could slow down the very substantial growth that we've seen in these industries, and as a result, also have a negative impact on overall levels of GDP growth. In our view, at the moment, it's unlikely to completely derail growth, but we could see a bit of a softening of activity in some of these key growth-driving industries over the next couple of months.
Right. All right, Matt, let's hope inflation peaks, at some point so we can get some normalcy with these economies. Thank you so much, Matt Kendiga, practice lead at Frontier View right there in Sub-Saharan Africa. Thank you so much.
Thanks very much.
All right, now let's move on to other stories. The European Union is working on a deal to import Israeli gas through Egypt as the bloc is looking to lower its dependence on Russian suppliers. The field would be converted to LNG, that's liquefied natural gas, at Egyptian processing plants before being shipped to the EU. Russia's war in Ukraine has sparked international condemnation and a move by buyers of Russian gas to secure alternative supplies. Since the EU imported around 40% of its gas from Russia last year, the bloc will need to seek multiple sources of the fuel as well as raising renewables output to meet demand. And Zimbabwe is easing controls on the national currency's official exchange rate, allowing it to converge with an interbank rate that the government has permitted businesses to use for commerce. The currency now officially trades at 290 Zimbabwean dollars per US dollar, according to the data from the central bank's website. After starting the year at 108 Zimbabwean dollars, the interbank rate is at 296. Well, the government has used various strategies to try to tame the local dollar's decline, including a 10-day ban on bank lending. The depreciation has spurred inflation, which surged to 132% in May, the first time it has been above 100% in 10 months. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Enjoy your weekend.